Hello, and welcome to this live webinar on possible research opportunities in IFRS 15, revenue from contracts with customers. This webinar is last in the series of webinars that we are holding on the post-implementation reviews of IFRS 9, IFRS 15, and IFRS 16 targeted at academics and researchers. If you're not an academic or a researcher, don't worry, you're more than welcome to stay. You can download the slides we are presenting today from the event resources box that you see on your left side on your screen. The slides are also available on our website. I am Raghava Tirumala from the IASB technical staff, and I'm joined here today by two board members, Mary Tokar and Ann Tarka. Please note that any views expressed by us in this webinar are personal views and not necessarily the views of the IASB board or of the IFRS Foundation. I will now hand over to Ann to explain the purpose of today's webinar.
Thanks, Raghava, and thank you all for joining us today. This webinar is not a tutorial of IFRS 15. Many of you have already been working with or teaching IFRS 15, but the idea is to stimulate academic research, the outcome of which could be useful to the board in its post-implementation review of IFRS 15. We value the evidence that academics can provide at various stages in the board's work. Evidence related to the application of IFRS 15 can provide a useful input into the PIR, along with the evidence that the board collects from a range of other sources. To give you a brief overview about why we are talking about a PIR of IFRS 15, let's consider the following. When IFRS 15 was issued, the board indicated that a PIR would be undertaken into 2 to 3 years after the effective date. However, compared to some of the earlier standards, the board was more active in supporting stakeholders while they were implementing IFRS 15, including forming a transition resource group that discussed implementation issues as they arose. This has reduced the immediate need for a PIR to identify any challenges that might need consideration by the board. We also think that to allow sufficient time for trend information about the effects of applying the standard and for academic research to become available. So for these reasons, we have not yet started the PIR, and we will actually discuss the starting date later in this year. Looking at our next slide, this gives us an overview of the material that we'd like to cover in the webinar today. So we have a 1-hour session. Following a brief overview about our post-implementation review process, we'll split the discussion into 3 areas of research opportunities. First, looking at the overall objectives of IFRS 15. Second, some specific topics within IFRS 15. And thirdly, about possible improvements in the board's standard setting process. So for each part, we're going to remind you what the board objectives and conclusions were in IFRS 15, give some examples of the questions that the board may have to answer in the PIR, and then talk about a few possible research opportunities to support those questions. If you have any questions that you'd like to ask, please use the question box on your screen, and we'll pause at appropriate times to take those questions. A recording of this session will be posted on our website. Now, Mary, before we get into the details of potential research opportunities related to IFRS 15, could you please shed some light on what a post-implementation review is for the benefit of our audience today?
Anne, thank you, and I'm happy to do that. A post-implementation review is an important part of our due process and aims to help the board assess the effects of a new IFRS standard on users of financial statements, on preparers, auditors, and others. And in particular, the board aims to assess whether a standard has improved financial reporting without disproportionate cost, and identify any lessons that will help it to improve future standard setting. So during a PIR, the board will assess whether the objectives of the standard setting project have been met, information provided by applying the standard is useful to users of financial statements, the cost arising for preparing, auditing, enforcing, or using the information provided by applying the standard are broadly as expected by the board when it developed the standard, and whether the requirements are capable of being applied consistently. If the actual effects are not as expected, the board then subsequently assesses whether any follow-up is necessary in either the short term or the longer term. I'd like to stress that a PIR is not an excuse to redo the original deliberations. It's about considering new information provided by evidence gained from actual application and use of the standard. Now, I hope this helps to make it clear for the audience why we want to encourage academic research on the effects of the application of IFRS 15. Now, Raghava, let me just stop and see if there are any questions that we should try and answer at this point.
Thanks, Mary. We do have a question. So how does the board use academic research in a post-implementation review? And if the board does use academic research, is it visible in the standard setting process?
I'll tell you what, I'll start on that, and then Anne heads up, maybe ask you to comment. And I'll start by saying, and I see we have a question in the Q&A function asking about how to submit research. What we rely on primarily is published or working papers research. So one of the key starting points for a post-implementation review is a literature review of to look for any applicable academic research. That literature review then is presented to the board in a public board meeting on the basis of a public paper, and items that are identified in that literature review that are particularly relevant are discussed by the board. Now, Anne, you did the literature review for our PIR of our business combination standard. I don't know if you want to comment or amplify my somewhat inexpert discussion of academic research. Over to you.
Thanks, Mary. Yes, I did write that literature review before being a board member. So the literature review covers that particular one, a range of issues, multiple research methods, and the studies were sourced from various jurisdictions. So the studies addressed some, but not all of the issues that the board needed evidence. So the board goes elsewhere for evidence as well, but the academic evidence is really important because of the nature of academic inquiry. And indeed, the feedback from the board members at the time was quite positive. They really appreciated seeing data and statistics that were relevant to the questions under consideration. But just adding to Mary's comments in relation to the question that's come through in the Q&A, we are actually happy for people to send in their papers, and I'll respond to the question so everyone can see it. But Anna Simpson receives emails with people's papers, and I'll pop her email so you can see it. And in terms of how long people have to do the research, as we're explaining this webinar, we haven't set the timetable for this PIR yet. So there will be some time lag before we commence and before we put out our request for information and before we conclude our deliberations. So this is why we're talking to academics so early now, just to flag, to let you know we're interested in research and you do have a considerable time period. I am talking a period, we haven't even opened up this PIR yet. So we are talking, there are many, many months involved, and indeed we'll talk later this year about what time, the timing of the one on 15. So, you know, we are already talking into 2022. Now, who goes next? Is it me? Right. Slide 7, I think. I'd like to talk a little bit about our approach to research. So we're certainly not attempting in this webinar to tell you how to go about doing research, but we'd just like to make some pointers for your consideration so that you can understand what's important for us in considering research, and that might help you make your research more meaningful. And I know everybody's interested in showing the impact of their research, and you'll be aware that we do cite research in our board papers. We bring those to your attention via our academic webpage and through social media. So we are using academic research on an active basis on many of our projects, and we are citing papers. So this is an opportunity for you to show how you're contributing to public policy research, which I know is a very important thing for the academics. So in terms of what we know about IFRS 15 that's relevant to you, well, firstly, the effects of applying IFRS 15 are not the same across all sectors. So there are some sectors where we expect to see significant changes in recognition and measurement of revenue, but other sectors where we expect to see fewer changes. But it's worth noting that we expect to see changes in disclosures about revenue across the board, that is for all entities. So in the appendix of the slide deck, we include some slides that explain high-level expected effects on recognition and measurement for a few sectors. So as you set your study design, it may be helpful for you to include some analysis that focuses on those highly affected sectors, albeit that you might be comparing those with sectors that have been less affected, but we are interested in knowing the impact into those sectors. And as we've already alluded, we're really interested in research that comes from a range of studies. It isn't an issue that, oh, somebody's already looked at this, therefore there's no point. When we've got so many entities, so many industries, and so many countries involved, we need to look beyond one study, and that would be sound practice anyway, to look for the evidence of a range of studies, and in particular a range of methods. It isn't that one particular method serves presenting evidence to the board better than another method. We do need people to be doing a variety of different methods. Some of the impact of IFRS 15 can be seen from financial statements. Other data is going to come through management commentary reports, investor presentations, and also investor and analyst reports. Some questions will be best addressed with a qualitative approach, and that could include interviews of preparers, practitioners, investors, analysts, various groups that are involved. We do want to point out that research can be helpful even if it focuses only on one aspect of a question that the boards are likely to consider, or only one particular stakeholder group. We understand the degree of depth that's required for effective research, and therefore it can make sense to focus in on a particular group or a particular aspect to a question. So for example, when we look at the costs to users of IFRS 15 implementation, people might just focus in on that particular thing and not try to cover other things as well. So with those introductory words, I would like to turn over to Mary now, and she'll talk about the board's expectations when they issued IFRS 15.
Thanks, Anne. And I'd like to, I'm pointing out for your information that our expectations for the standard are captured in the basis for conclusions that's published with the standard. So if there's anything that you want to see if you can get more information about, that the basis is a really good starting point for understanding our objectives. So with that note behind us, let's start with when was it issued? It was issued in 2014 with an effective date of 1st of January 2017, which subsequently was extended by 1 year to financial years beginning on or after 1st of January 2018. Now, this standard was developed jointly with the U.S. Financial Accounting Standards Board, and today it remains a substantially converged standard. Therefore, capital markets around the world should be benefiting from comparable approaches to reporting revenue. For us, IFRS 15 replaced two very old standards and their related interpretations. To support implementation of IFRS 15, the board also issued a few targeted clarifications in 2016. These areas were identified from the work of the Transition Resource Group that Anne mentioned a couple of minutes ago. IFRS 15, the revenue recognition standard, has a very broad scope covering all contracts with customers for goods or services, except for those covered by more specific standards, such as, for example, leases or insurance contracts, or indeed financial instrument contracts. So let's look at what the board set out to achieve. IFRS 11 and IAS 11 and IAS 18 had gaps and really, frankly, lacked a robust basis for recognizing revenue, which could make them difficult to use, particularly in more complex contracts. For example, IAS 18 required entities to separate deliverables promised in a contract, but it didn't include any guidance for how to do that, and it provided very little measurement guidance. There also were relatively few disclosure requirements. So users of financial statements, therefore, often depended on entities voluntarily disclosing information outside of the financial statements. Consequently, the two standards were not always providing useful information to users of financial statements. So this gave the board a very clear motivation and objective of improving the quality of information provided by an entity about its revenue. To achieve the objective, just focusing on improving disclosure would not have been sufficient. So the board sought to develop a robust framework for entities to determine when and how much revenue to recognize. IFRS 15 uses a 5-step framework with clear objectives for each step, supported by application guidance. And as I said, our objective was to provide a robust framework with adequate guidance that would work both across a range of entities and over time for an individual entity's business and products as that range of offerings evolved. And I'll talk about the 5-step process a bit more in a minute or so. The board also significantly enhanced the disclosure requirements to enable users of financial statements to understand better the prospects for future revenue and cash inflows. And I'll talk about those improved disclosure requirements in a few minutes too. And so continuing on with this theme of what did we set out to achieve is, if I go back to the problems I was enumerating with the old standards, IAS 11 and 18, another problem was that entities were not following consistent practices for recognizing revenue. In some sectors, some entities were looking to more industry-specific guidance that had been developed under U.S. GAAP. In the U.S., the FASB also reported facing issues with a lot of industry-specific guidance and the associated inconsistencies and complexities. And the result was that revenue information was difficult to compare across entities in the same sector and across sectors and jurisdictions. And it's important to focus on this in terms of understanding where the board was coming from and what it was trying to achieve, because at least for me personally, it's perhaps the most important improvement introduced by IFRS 15. And so businesses are evolving rapidly, and inconsistent industry-based practices were, to me, a barrier to useful information. And let me give two examples. I'm going to start with Nokia, which started as a wood pulp mill that branched out into electric generation before merging with a company that manufactured rubber boots, car, and bicycle tires. The phones that it manufactured competed with Apple's phones. Now, Apple started as a hardware manufacturer and seller, developed and bundled its own software, and now also has a significant content provider business. Inconsistent industry-based approaches to revenue recognition do not help with understanding how a business is evolving, because under IFRS 15, because all entities apply the same 5-step framework, there should be consistency in revenue recognition policies. Revenue information provided by entities in a sector, across sectors, and jurisdictions should be comparable. So, if an entity's business is licensing intellectual property, then its revenue recognition practices should not depend on whether it is a software developer, entertainment provider, or a pharmaceutical company, all of which have significant IP licensing activities. So that's an insight into really one of the critical things we were trying to do. And now let me turn to just a quick look at the 5-step model, which is one of the major tools for achieving that goal of improved comparability. IFRS 15 has a simple and, to me, intuitive core principle, and that core principle clearly explains what revenue depicts. It's to recognize revenue to depict the transfer of goods or services in an amount of consideration which an entity expects to be entitled. To apply the core principle, an entity follows the 5 steps that you see summarized on the right-hand side of this slide. And these steps provide a logical process for working through a revenue transaction to determine when and how much revenue to recognize. Just looking quickly at the 5 steps. First, an entity identifies the contract with its customer. Second, it then identifies what its performance obligations are based on an assessment of the goods or services promised to the customer. As a third step, it determines the transaction price that represents the total amount of revenue to be recognized over the life of the contract. The fourth step is taking the transaction price, which we've just determined, and allocating it to each performance obligation that was identified in step 2. And then the last step, step 5, is to recognize revenue when or as each performance obligation is satisfied. So one of the things I want to point out to you is that performance obligations are the heart of this model. Performance obligations are the parts of the contract that are accounted for separately, and therefore the way that they are identified in step 2 affects both the recognition and the measurement of revenue. Okay, so that's our overview of the 5-step model in IFRS 15, and really everything technical hangs off of that. But let me turn now and just talk briefly about our expectations about costs. Now, given the extent of change that IFRS 15 was expected to cause, the board expected that there would be costs to implement the standard. Some of those costs would be one-off, and some of those would be recurring. Now, given the breadth of entities and industries that would be moving to IFRS 15, it was, however, difficult for us to generalize the expected costs. This is in part because the cost is going to depend on your starting point, and starting points were different. As with any new standard, entities may have incurred initial costs of implementing changes to apply IFRS 15. The enhanced disclosure requirements may have resulted in entities incurring higher recurring costs. Users of financial statements may also have incurred costs because they would have had to adjust their models, but we also thought that some would have cost savings because it would be easier to collect information that now would be available from financial statements because of enhanced disclosures. The board's overall conclusion on costs was that the benefits of the standard outweighed the expected costs. Okay, and now I think that I am going to hand over to Anne to talk a bit more about some potential research opportunities.
Thank you, Mary. We can see from Mary's discussion that the reasons for issuing IFRS 15 were quite compelling. So the board in the PIR is likely to want to evaluate whether, firstly, the overall objectives of improved information and improved comparability have been achieved, and secondly, the effects of applying IFRS 15 have been as expected. So the slide list includes a list of questions that the board may want to explore in the PIR of IFRS 15. We hope this list is useful because it shows the sorts of questions the board will need to answer. So questions like these, under the headings of improved information, improved comparability, and unexpected effects, may help you to decide on the areas of IFRS 15 implementation where you could usefully focus your specific research questions, and by doing that, contribute to evidence that will help us with our overall assessment. Now, what we'd like to do next is to move on to the next section of our presentation that talks about potential research opportunities on specified topics within IFRS 15. So Mary, back to you.
People will be tired of the sound of my voice, Anne, but thank you. What we tried to do in this next section is to identify a few topics in IFRS 15 to illustrate potential research opportunities. We are not trying to do a comprehensive list of potential topics for which there are research opportunities. We just thought it would be more helpful to have specific examples of how research relates to different areas of the standard for where the board was trying to address specific financial reporting problems and where we were thinking it's likely that we are going to have as a board to make an assessment of the effectiveness. Now, these topics also happen to be some of the key areas of judgment in applying IFRS 15. And luckily, I get to turn over to Raghava to take you through each of these topics, and I'll be back for the disclosure discussion. So, Raghava, over to you.
Thank you, Mary. The first area we thought would be good to look at was principal versus agent. So when a third party is involved in providing a good or service to an entity's customer, the entity has to determine whether it is supplying the good or service to the customer, that is, the entity is the principal, or the entity is only arranging for the good or service to be provided to the customer by the third party, that is, the entity is an agent. Therefore, in IFRS 15's 5-step framework that Mary went through a little while ago, this is a step 2 question, because fundamentally it is a question about what is the entity's performance obligation. Now, the previous revenue standard IAS 18 provided a list of indicators for distinguishing whether an entity was a principal or an agent, but lacked a clear objective for making that distinction. Therefore, entities with the same fact patterns could be reaching different conclusions about whether the entity is a principal or an agent. And of course, those different conclusions have a significant effect on the top line, even if there is no impact on the profit, because an entity recognizes only its arrangement fee rather than the full revenue for the underlying good or service. The board was aware that principal versus agent assessments was a significant issue for many securities regulators. Hence, with IFRS 15, the board tried to provide clear principles to help entities in distinguishing between a principal and an agent, and to align, most importantly, the amount of revenue an entity recognizes with the nature of its promise. So, how did the board go about addressing the issue? So, IFRS 15 uses the concept of control to help determine whether an entity is a principal or an agent. So, an entity uses a 2-step process. First, the entity identifies the specified good or service. So, for example, if I'm a travel company selling airline tickets, the specified good that I am providing to my customer is a flight ticket, but not the service of flying the customer. Secondly, the entity assesses whether it controls the specified good or service before it is transferred to the customer. Now, continuing the example of the travel company, if the travel company can direct the use of the tickets, that is by selling it to customers or using them internally, etc., the travel company is a principal and recognizes revenue from the sale of tickets and not just the commission included in the price of the ticket. IFRS 15 provides some indicators to help entities assess whether the entity controls the specified good or service before transferring to the customer. So with that, I'll now pass over to Anne for the potential research opportunities on this topic.
Thanks, Raghava. So looking at our next slide, the board is likely to have several high-level questions that it needs to address in this PIR. So one that's stated here is about whether new requirements support making better and more consistent judgments by entities, auditors, and regulators about when an entity is acting as a principal and when it's acting as an agent. Now, there's a strong line of research into judgments and decision-making. So academics may want to investigate the judgments made by companies and auditors regarding determinations of when an entity is a principal and when it is an agent under IFRS 15, given that we've now got new requirements and guidance. Another area of work could be to consider the responses of regulators to entities' applications of the new requirements. Revenue recognition is a topic of fundamental interest to regulators, and research could consider the implications of the issues that regulators are identifying relating to IFRS 15. I'm handing back to Raghava now to talk to you about variable consideration.
Thank you, Anne.
Raghava, are you on mute?
Yeah, sorry. Yeah. Thank you, Anne. So moving on and turning to step 3 of the model, determining the transaction price, IAS 18 and IAS 11 worked reasonably well when the consideration for the good or service was fixed. However, those standards had very little guidance for when the consideration was variable, even though variable consideration occurs frequently, such as when the consideration depends on performance targets in a contract. Variable consideration also includes situations when the consideration is generally thought to be fixed, but there are possible refunds or rebates, including basic features like returns or the sales returns. So there was therefore mixed practice. Some entities would estimate variable consideration, others did not, and would recognize the variable consideration only when the uncertainties were resolved and it was no longer variable. So the board was told by users of financial statements that the most relevant measure for revenue in a reporting period would be one that will not result in a significant reversal of revenue in a subsequent period. So to address the problem, what did the board do? Now, IFRS 15 provides a two-step framework. An entity first estimates the amount of variable consideration using either the expected value method or the most likely amount method. The entity then constrains the estimate so that it is highly probable that the cumulative revenue recognized is not subject to significant reversal in the future. Now, I know you might all be thinking IFRS 15's wording is this awkward. The hurdle of highly probable applies to something that is reversal of revenue recognized, so something that's not happening. IFRS 15 also provides a few indicators to help apply the constraining requirement. It's important to view the constraint as more of a ceiling on revenue rather than a prohibition on its recognition. So an entity cannot default to zero. So an entity has to work through the two-step process to estimate the variable consideration that should be included in the transaction price. it cannot default to recognizing revenue on a cash basis when there is variable consideration. Over to you, Anne.
Thanks, Raghava. So looking now on slide 22, we expect the board to consider whether the new requirements result in information that is useful just for decision making. And we know that researchers have a range of techniques that they use to investigate usefulness of information. So for example, capital market studies look at value relevance and information asymmetry. On the other hand, behavioural studies look at the effect of alternative measurement techniques and presentation formats. So both approaches have provided insights in the past and could be used to investigate various aspects of IFRS 15. Questions about consistent application over time between entities and sectors are often investigated based on the content of financial statements. In relation to whether application of requirements is costly, researchers may conduct interviews or focus groups with different groups of stakeholders like preparers or auditors or investors. And in this way, they could find insights on this topic. Raghava, coming back to you now.
Thank you, Anne. Another aspect of step 3, determining transaction price, is dealing with situations when the consideration is not due at or around the same time as the entity provides a good or service. So if the terms of payment provide either the customer or the entity with significant benefit of financing, recognizing revenue based on the promised consideration would not faithfully represent revenue because there's a financing element in the contract. Applying IAS 18, entities typically separated a financing component when the consideration was due an extended period after the entity provided the good or service. However, entities rarely separated a financing component when the consideration was received in advance of the entity providing the good or service. So the board concluded that to meet the core principle of IFRS 15 that Mary explained on slide 12, any significant benefit of financing, whether received by the customer or the entity, should be separated. Therefore, IFRS 15 requires an entity to separate from revenue any explicit or implicit financing component. Now, by explicit, I mean if there was a separate financing contract, and by implicit, I mean if the terms of payment are such. The objective of the requirement is that revenue should reflect the amount that the customer would have paid or received at or about the time of the transfer of goods or services. When customer pays in advance, the entity receives the benefit of financing, and therefore the entity recognizes an interest expense from the time of receiving the advance until transferring the goods or services. When customer pays in arrears, the customer receives the benefit of financing, and therefore the entity recognizes interest income from the point of transfer of goods or services till the time of receipt of cash from the customer. Having said that, IFRS 15 highlights that significant financing does not always exist when there are advance or deferred payments. For example, retention money, the purpose of which is more to enforce performance and not really to provide a benefit of financing. So an entity uses judgment in concluding whether there is a benefit of financing in the payment terms. Also, to ease application, IFRS 15 provides a practical expedient so that financing of up to 12 months is not required to be separated. Over to you, Anne.
Thank you, Raghava. So this question for the board again relates to usefulness that I've touched on in my previous comments. But this area looks at new reporting requirements, and information about the impact of those requirements would be relevant. So, for example, how widespread are significant financing requirements in contracts with customers for IFRS reporting entities? Evidence that could be helpful to the board may come from examining the disclosures entities provide about significant financing components and the firm or industry factors associated with these disclosures. Addressing the issue of significant financing components added complexity to the standard and the standard setting process. So it would be useful for the board to understand how pervasive significant financing is outside of financial institutions, so that the board has more specific information to evaluate how much guidance is needed on this point in future projects. Raghava, back to you.
Thank you, Anne. Turning now to the last step in the model, step 5, recognizing revenue when or as a performance obligation is satisfied. Now, IAS 18 and IAS 11 had separate revenue recognition requirements for goods and for services. Revenue from sale of goods was recognized when an entity transfers substantial risks and rewards of ownership of a good. Now, because of the subjectivity involved in assessing whether substantial risks and rewards have been transferred, there was inconsistency in how entities determined the point at which revenue should be recognized, or the point at which substantial risks and rewards have been transferred. And now, revenue from services was recognized on a percentage completion basis as the entity provided the service. At times, the measures of progress selected by entities or the measures of progress used resulted in an even recognition of margin over the contract duration instead of reflecting the progress towards complete satisfaction of a contract. So the focus was more on margin rather than the revenue. In addition, at times, there was diversity in determining whether the entity was providing the good or providing the service, and therefore which revenue recognition model should be applied. For instance, was the entity's obligation to provide a completed piece of real estate, or was the entity's obligation to provide the construction services and materials? So the determination of what the performance obligation was, affected the model that the entity was using in the past. Now, how did the board address this problem? So the board developed a single framework to determine the timing of revenue recognition for goods or services based on when the customer obtains control of the asset. So the way it works is that an entity first assesses whether control of good or service is transferred over time. To do that assessment, IFRS 15 provides 3 criteria, each of which are designed to capture different types of service contracts. If control of a good or service is transferred over time, the entity selects a measure of progress to depict its performance in transferring goods or services to the customer. If none of the 3 criteria for transfer of control over time are met, the entity concludes that control of good or service is transferred at a point in time. IFRS 15 includes a set of indicators for an entity to determine the point at which control is transferred. Over to you, Anne.
Thank you, Raghava. So in terms of potential research opportunities around this satisfying performance obligation step, we've noted that the new revenue recognition model is a major change introduced in IFRS 15. And so there is a good opportunity for researchers to provide feedback on its application. And a key area of interest is the timing of revenue recognition. So evidence about how the requirements for point-in-time and over-time revenue recognition have been applied, and how these new requirements have affected the information provided to users would be of interest. For example, returning to Mary's previous example, are licenses of intellectual property analysed consistently when comparing, for example, entertainment, software, and pharma entities? And this phrase, analysed consistently, should lead to different revenue recognition when facts differ within and across industry types. One research approach is to seek insights from data within annual reports, as well as in the financial statements and the management commentary. Another approach would be to speak directly to investors and analysts who are using the information. In addition, it may be possible to investigate the impact for users by exploring changes in properties of analyst forecasts for a set of companies, including affected companies. So let's pause here, Raghava, and see if we have any questions from the audience.
Thank you, Anne. We do have a question. So your presentation, our presentation has shown that IFRS 15 may change revenue recognition and measurement as well as presentation and disclosure. So if a researcher wants to study some of these changes, should they look for data about financial effects in the financial statements, or should they look elsewhere? So that's the question, Anne.
Thanks, Raghava. So some of the accounting effects of IFRS 15 may be shown in the financial statements. For example, there could be note disclosures about the timing of revenue recognition, about variable consideration, about disaggregation of revenue, about contract balances, significant judgments, and costs to obtain and fulfill a contract. Examining these note disclosures may show some of the impacts of IFRS 15. However, there are other types of data collection that could be very helpful to the board. We've received feedback that for some entities, adopting the 5-step model did not significantly affect the amount of revenue. So looking at the change in amount of revenue may not show an impact of the standard, but asking preparers or auditors through interviews about their experiences of applying or auditing the standard could reveal a wealth of interesting detail that would not be found in the financial disclosures in the financial statements.
Thank you, Anne. I'm now going to ask Mary to introduce the disclosure requirements in IFRS 15.
Okay. Thanks, Raghava. As we said at the beginning, disclosures are a very important part of IFRS 15 in the improvements that the board was seeking by developing the standard. IS 11 and 18, the standards that IFRS 15 replaced, had few disclosure requirements and were not serving the purpose of requiring useful information about revenue, even though revenue is often the starting point for analyzing an entity's performance. So one of the board's goals with IFRS 15 was to provide users with better insights into how an entity earns and reports revenue and what key judgments and estimates are involved. Therefore, the board developed an overarching disclosure objective, which is to enable users to understand the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. It's important to keep this in mind because the board did not intend the disclosure requirements to be treated as a checklist to be applied, but rather as an opportunity for an entity to tell its story about its different sources of revenue and how it has applied the principles in IFRS 15 to its own particular lines of business and types of contracts. So if we look at the next slide for a little more detail on this, I'm going to highlight a couple of points about IFRS 15's disclosure requirements. First is disaggregation of revenue. This is something that users told us is very important. So IFRS 15 requires an entity to disaggregate revenue into categories that depict how the nature, amount, timing, and uncertainty of revenue and cash flows are affected by economic factors. IFRS 15 includes some examples of the types of categories that may be appropriate, but the board intended entities to determine the type of category or categories that would be useful to users for their specific circumstances. Second, IFRS 15 requires disclosures about the significant judgments that an entity has made in applying IFRS 15 to its contracts. These are important disclosures because the standard is built on the use of judgment within the framework provided by IFRS 15, and that framework is the 5-step model, objectives for each step, and application guidance. So when these judgments affect the timing or the amount of revenue, it is useful for users to know how the entity has applied the standard. So against that background, let me hand over to Anne to comment about potential research opportunities related to disclosure.
Thank you, Mary. So looking now at slide 31, what we hope we've communicated to you is that the new disclosure requirements are extensive, and I would suggest they represent a rich field for investigation. There's much that the board would like to know. So beginning with, for example, how do the sectors and countries compare in their application of the requirements? What is the nature and extent of disaggregation of information about revenue that's provided? Thinking, for example, about variable consideration, the contract balances, or the costs to obtain and fulfill a contract. What insights can researchers give about the usefulness of the disclosures, about entities' judgments and estimates? Mary's mentioned how important it is getting an entity view that involves various judgments and estimates. What can researchers tell us about those disclosures and the factors that are associated with making those disclosures more useful? What are provided for entities by combining the combination of the objectives, disclosure objectives and disclosure requirements, versus how standards were in the past with a list of disclosure items? So we'd be interested in knowing if there are better insights for users from encouraging an entity to tell its own story. Are there costs to users for trying to compare information that may be provided in different ways and different formats by various entities? So lots of things under the disclosure heading. I'll just check with Raghava and see if there's any more questions from the audience.
Thank you, Anne. I think we have one question here. So the question is, I am interested in exploring the real effects of accounting standards. Are there opportunities to look at real effects of IFRS 15?
Thanks, Raghava. So real effects of accounting standards. I think that the answer to this question is yes, but let me just clarify what the questioner means by real effects. So I'll explain what I assume the questioner means. So researchers describe accounting effects as the impact of the changes in the standard on the numbers in the financial statements. So that would be a direct effect from the standard to the changes in the financial statements. But some researchers also investigate something they describe as real effects, being additional effects of the accounting standard. So real effects could be the changes that an entity makes in its operations and its activities because of the standard. So for IFRS 15, a study of real effects could investigate implementation and application costs. Another area is whether the standard has affected the contracting of the entity, for example, in relation to debt covenants or remuneration contracts. I should just mention at this point that we did have a very interesting discussion at our research forum in 2020, and we had an interesting paper on IFRS 15 from Professors Napier and Stadler. So that's Napier and Stadler. It's published in Accounting and Business Research 2020. And if people are interested in a discussion on real effects and IFRS 15, I recommend that paper for you. So we'll now move to the last part of our presentation, and that's looking at the contribution that potential research opportunities make related to improving our standard setting process. So Mary, over to you.
Okay, thanks, Anne. Just closing with the observation that while each PIR focuses on a particular standard and subject, and today we're looking at IFRS 15, which addresses revenue recognition. However, each PIR is also an opportunity for the ISB to stand back and consider whether there are any lessons for the standard setting process that can be applied to other topics, projects, and standards. For example, this is a simple one, IFRS 15 had transition requirements including an option regarding the extent of restatement of comparative information and some compensating disclosure requirements if less information was restated. So how useful was the expedient in terms of prepare or cost savings? in terms of understandability for users? Should we ever consider doing something similar in future? Those are all examples of kind of general learning points that we could take for other standards from experience with IFRS 15. And so I think now I'm going to pause and see, Raghava, if we have any more questions.
Thanks, Mary. I think we probably have one last question and time also to take that question. So you mentioned that IFRS 15 and FASB's Topic 606 are substantially converged standards. Do you see any benefits in examining both groups of entities, those adopting IFRS 15 and those adopting the FASB standard?
Okay, let me start with the observation that I think our first focus will be on evidence from entities using IFRS 15. And IFRS 15 is used in many jurisdictions, so there are opportunities to explore how countries' institutional settings, for example, country-level features such as strength of regulation, law, and governance, affect application of the standard, if at all. There also are approximately 500 foreign private issuers listed in the U.S. and use IFRS standards, so would apply IFRS 15. I think a study of these companies and U.S. entities that use IFRS standards could yield some interesting insights about how certain factors impact the application of IFRS 15. But I'll close by saying I can think of circumstances, other PIRs, and again, and the business combination one is one where we thought evidence from application of U.S. GAAP, because again, it was a substantially converged standard, was relevant for our consideration. But I go back to I think we'll focus first on evidence from entities using IFRS 15. Raghava, anything else?
Thanks, Mary. No, we don't have any questions, so I'll now ask Anne to make the concluding remarks.
Thank you, Raghava, and thank you, Mary, for those comments about US GAAP and IFRS 15. So it's time to conclude our webinar. I'd like to thank all the people who have participated today and put in questions. We do hope that our webinar has been useful for you and has got you thinking about IFRS 15 related research questions. We're very keen to see the academic work, and as I said at the beginning, we've timed this webinar to give you plenty of time to undertake such research. So with that, I would just like to conclude on behalf of Mary and Raghava. Thank you for your time, and let us encourage you to get into the data and start exploring what the application of IFRS 15 can tell you. So thank you very much, and we'll now conclude.